Welcome to the Global Rewire Podcast. I'm Craig Torres, and I'm here with my co-host, Fabio Natalucci. Fabio, recently, German bond yields hit an 11-year high. And in Japan, long-term bond rates are up about a point from a year ago. And in the U.S., long-term bond yields are about the same they were a year ago, even while the Fed has been cutting interest rates. So something's going on in sovereign debt. And here to discuss with us is Lupin Raman. She's an expert in the field of both developed markets and emerging markets. She was head of sovereign debt investing at PIMCO. She's worked at the IMF and at the World Bank. And she has a new book out, The Sovereign Debt Investor. Take it away, Fabio.
Yeah, thank you. Welcome, Lupin, to the show. I
Thank
would suggest anyone to read the book, actually. It's a really, really nice book. So if you didn't have a chance to do it, just go ahead and buy the book and read it. It's a lot of information there. Maybe we start with a big picture question and think about global savings, how they've been allocated, invested during this cycle where we are today. There's a lot of changes, structural changes happening in the world now, from geopolitics to innovation and AI to digital finance. And I think what is unique that they're all happening at the same time, and a lot of this originates in the US. And at the same time, the US has been the traditional global habitat for global savings, right? Because of feature of US financial markets, debt, liquidity, the institutional setup, the legal framework. I just started maybe from there. What is your take? Are there any of these big changes affecting this framework? How do you see that?
So first of all, thank you so much, Craig and Fabio, for having me on the podcast and the kind words about the book. Much appreciated. I'm looking forward to the discussion because we have a lot to talk about. And I like the way you framed the topic in terms of, let's talk about global savings and where they're invested right now, and how are they going to react, or how are they reacting to the large market moves that we've seen in advanced economies. So I think, look, there are many pieces to this, but what we can say is essentially the attraction that the US Treasury market has for this very large pool of savings is something that's going to continue for some time, at least the foreseeable future. This is a almost $30 trillion market. The next largest bond market, just by size, if you're looking at, say, Japan at around 9 trillion, China at around 6 trillion, the combined euro-denominated debt market also around 9 trillion, the bond market close to 2 trillion. Those markets all have their own issues in terms of why it hasn't been able to absorb that much of a diversification flow from US Treasuries. So Fabio, as you mentioned, the scale and depth of the US market is one factor. There's also the factor that the US markets are exemplary in terms of turning these saving assets into marketable collateral assets. That's incredibly important for many users of the US Treasury market. And then you have more broader issues in terms of liquidity, in terms of price discovery, the institutional credibility, which is being tested for sure. But in terms of the starting levels, and if you're looking at the world from a clean as dirty shirt perspective, the US still stands out. Having said that, we cannot ignore what we're seeing in the markets right now. And I think that there are a couple of factors in play. There is the first factor, which is essentially who is the marginal buyer of treasuries. And what we're seeing from the TICS data is essentially a movement away from the official sector being the incremental buyer to the private sector, so banks and non-banks and other foreign owners. That's important. So, it's important not because we expect a forced sale of the stocks, but in terms of the flow, which is an important factor in the marginal price setter of treasuries. The second factor that is also incredibly important is in terms of how should we think about what the signals that the treasury market are telling us, and broader advanced economy markets when we're talking about yield increases in the long end of the curves. And here, we could fragment that and segment that into the standard macro factors and whether we're actually seeing an increment of real yield and credit pricing that's being priced into the US Treasury market. I think that the jury is still out. What I would look for in terms of whether higher yields are a signal of just pricing factors that are related to regular global macro factors that we typically look into in fixed income analysis versus an actual call on the credit and credit worthiness of US Treasuries is probably another element that is creeping in. But there are several signals that we often look for in emerging markets, and we can apply that to advanced economies as well to break that down.
You mentioned the size of a number of these markets. The Japanese market, the combined Europe. Combined, it's a tricky concept for Europe, right? Because there are different countries with different rules, with different credit profile, different ratings, and so on. And then China, obviously. Where do you see any of this in the foreseeable future to actually challenge the dominance of the dollar and the US dollar-denominated sovereign debt?
I like the distinction that you made between the dollar and dollar-denominated debt, because I think that distinction is really important, because we have on the one side, you have one debate about dollar debasement, the hegemony of the dollar as the key currency in which assets are invested in versus dollar-denominated assets, which I think it is a different, slightly related but different issue. So let's take the issue of just the size of the various markets. I think what we are seeing, and we have some very prominent institutions that have come across and verbally said that they are diversifying away from dollar-denominated assets in the long term, is essentially where the recipient of these flows can go. And I think it is natural to consider the bond market or the wider euro-denominated asset market as a potential recipient. You also have the JGB market, and we can talk a bit more about essentially what we're seeing in the JGB market and the Japanese yen and how that relates to the US Treasury market later on, and also the Chinese market. Each of these markets have their own deficiencies, right? In the euro-denominated market, as you mentioned, it's a fragmented market. It's a large size, but still not comparable, also fragmented. You have the issues of what the fiscal autonomy and backstop is actually going to be. And if you're narrowing yourself down to the bond market, which may be the closest competitor in terms of providing that liquidity depth and being a safe asset for global savings, you still have an issue of scale, an issue of other factors related to market plumbing. So that's not really a complete substitute. You also have issues in the Chinese market, the capital controlled, again, institutional credibility, depth of liquidity, openness to foreign ownership. That's one factor that the US markets have. It's like complete openness to foreign ownership of its assets, which really sets it apart in terms of being that safe haven for global assets and global savings. Finally, if you're talking about the JGB market, there's an issue of, what the liquid float is. A lot of this paper is held domestically. It's held on balance sheets that aren't traded, which also limits the capacity to absorb any diversification flow. That said, I think what we are likely to see is the incremental shift rather than a large-scale forced sell. I think no one is really talking about a forced sale of treasuries, but the question really is, what is the diversification of marginal flows into the treasury market? And we are likely to see, and we have seen, especially in 2025, that shift towards other assets. What it's likely to be is a combination of various safer or pseudo-safer assets that provide some of the elements of what the treasury market provides, which would be a combination of the factors that we mentioned, together with a search for yield. And this is where an interesting part of the asset menu, which is emerging markets, comes into play, where last year really we saw a combination of search for yield as well as a rediscovery of the improving fundamentals of many emerging markets as a viable diversification play away from the dollar, like from dollar assets.
I just wonder, Lupin, so, you know, taking Carney's speech where middle powers are going to form new alliances and trade for their products and everything else, doesn't this mean if we're putting tariffs against people who import here and we have middle powers forming new alliances, that the dollars of exporters are going to be, they'll have different currencies now because they're trying to export to different nations. So at the margin, maybe the amount of dollars in the corporate treasury will be less. Now, they can always swap back into dollars and stay in a dollar world. But how do you think this plays out over time? Are there going to be, just less foreign exchange outside the U.S. that's held in dollars?
U.S. trade policy and tariffs have quite a complex impact on just dollar assets and the generation of dollars abroad. And I think you're right to focus the distinction between trade flows and essentially other sources of dollar assets. What we have seen in the short term, there's unlikely to be a significant impact. And the reason for that is because most of the dollar assets and dollars that are generated abroad for investment into the US capital markets is not coming from the trade account. It's actually coming from the capital account. And we've seen that grow over the last decades quite significantly, especially in emerging markets, even though the headline is always, China's trade surplus versus the US. If you look at the major flows of capital, they're really coming from the capital account in emerging markets. But I think long term, the shift is going to be important in terms of where the sources of dollars are going to flow and within which regions. And so you do expect to see some regional fragmentation in terms of where the pockets of dollar liquidity is going to emerge. And I think that is going to be probably another factor for us to look into. But I would say, in the near term, it is less of a binding constraint. Even in the long term, I think that what it will change is kind of the focus and the regional types of flows that are coming into the US assets and the US markets versus the overall volume. I think that's still an open question in terms of what happens to the overall volume of dollars.
So if I can shift back for a second to Europe, you mentioned the size of the combined market. There is, I think, something new that is emerging in Europe, which is the realization that the US will not provide defense for free, essentially, and maybe disengage with NATO. Has pushed, kind of like crystallized in Europe capitals, this idea that there is a need to push up the expenditure in defense in terms of as a share of GDP, in terms of contribution to NATO, in terms of building a supply chain. And all of these various initiatives in place there between the financing of Ukraine, those 90 billion euros, the safe facilities, another combination of different measures that have been considered or taken, even rethinking the mandate of the European Investment Bank, possibly even the ESM, more tailored toward defense supply chains. Let's say $1 trillion, €1 trillion, just as a number. It's round and nice. What that means in terms of alternative as a liquid asset, this is not at the national level, right? This is at the Eurobond level in terms of a different kind of like alternative to dollar assets, to treasuries. And also what it means in your mind for US rates. How much of this is going to be a gravitational pull for long-term US rates? Like Craig mentioned that the Bund 30-year have increased quite a lot. Europe not much, US not much, despite the Fed was cutting. If that 1 trillion euro bonds come into life, how much do you kind of weight on US rates?
So I think that Europe is doing quite a few interesting things, including this potential euro mutualized debt issuance. Already we've had some of that already, but the numbers that are being proposed now, 1 trillion, 1.5 trillion euros, is quite unprecedented and large compared to the footprint of the market. I was also interested to see the announcement of euro swaps from the ECB. I think that's also an interesting um, different policy tool to think about how euro availability for non-banks is going to be affected as opposed to the dollar liquidity swaps, which is the more standard in those markets. So I think Europe is doing some interesting things towards improving the kind of safe asset credibility of euro paper. Now, to your question about, how to think about how markets may interpret this 1 trillion in issuance that may be coming, I think that it really depends on how it's framed. I think, first of all, thinking about $1 trillion in assets as a new safe asset where global investors and global savings can pool their money into is probably a welcome factor. And no doubt it will, if actualized, result in more pressure on the back end of the US curve, right? Just a simple matter of demand and supply. Um, Having said that, I think that, there are a couple of things to take into consideration. I do believe that investors will demand this paper simply because of the pickup that you would have versus bonds. If you believe that it is backed by the full faith and credit of the German government and the German Treasury, in effect, you're getting a free lunch as an investor. So I do think the demand is going to be there. But in terms of, really the price dynamics going forward, if this is framed more as integration of the EU financial markets coming closer together, perhaps more integration on the fiscal side rather than profligate fiscal spending on defense, or even if it's, some element repackaged as some element of infrastructure spending. I think how that is framed in terms of the fiscal rules and fiscal discipline of the union is going to be important in terms of how that affects the own internal yield curve of euro assets.
I mean, obviously, the next step there, if you really want to compete with dollar asset, would be to have deep capital markets, right? So the saving and investment union, ideally, you want to have that proceed in parallel to this so that you provide an alternative, not just a safe asset in euro-denominated, but also euro-denominated broader asset classes.
Right, exactly.
Do you think all this talk about fleeing the dollar habitat is overdone? I was thinking if you're an emerging market and your exports are in dollars, like the Gulf petrostates, they're not emerging markets, but they've done very well with their dollar linkages. In fact, some of them even have exchange rates that are relatively fixed to the dollar. If you're Norway, you're doing pretty well in a dollar habitat. Your main export is oil. I wrote a piece recently saying the case for dollarization in Venezuela looks pretty good, actually. So is there any reason, a strong reason, if you're a big exporting nation with dollar-based commodities, where the market for your commodities is dollarized and very liquid, is there any reason not to kind of hug the dollar as a nation?
So there are many elements to that, right? The first element is if you have global savings, if you're an institution or an organization that has a large pool of savings, do you put that in dollar denominated assets? The second is, do you have a view on the dollar in terms of the near term or the long term structural view? Do you expect the dollar to actually appreciate, depreciate? Is this going to be more of a cyclical, policy driven shift, or is it there's something more structural? So that's another element. And then the third element really is, if you are a country or a nation that has a significant amount of dollar invoicing and perhaps very low credibility in your local currency, do you dollarize? So there are three quite distinct topics, right? And I think we've covered the first topic in terms of, dollar assets, what people are kind of thinking about shifting or diversifying on the margin away from dollar assets to the extent that they can. I think the second topic in terms of the outlook on the dollar, We can also debate whether the dollar is on a secular depreciating trend or whether this is more of a cyclical shift. I think what we're seeing just in terms of the near-term outlook is that the pressures on dollar weakness are probably likely to be there. Um, on the third element, which is directly to your question, there are good reasons and there are fundamental economic reasons why some countries are better off being dollarized or trading mainly with the dollar. The downshot of that, of course, is you lose monetary independence. Now, it's worked very well in places like Ecuador, but currency boards, which tend to be the first kind of prelude to dollars, in many cases have not worked. And part of that is because the simple underlying initial conditions, and in particular the fiscal side, hasn't matched with the kind of the ambitions of the monetary side. So, my answer to you is it really depends case by case. If you're looking at heavily dollarized countries or countries like Saudi Arabia or other very large oil producing nations, they tend to have dollar pegs. And I think that they work for good reason. But countries where you have a broader trade mix, I think that you're giving up quite a lot. And typically there are other ways to gain policy credibility, right? I would say it's probably one of the tail options that a country follows if it hasn't really been able to kind of anchor its credibility using other means.
A while ago, I was talking to an advisor to sovereign wealth funds, and he was saying, in their risk models, and probably in the risk models you worked with as a portfolio manager, the dollar was the bid in times of global stress. You would increase your treasury allocation. Is that still a safe trade and the right trade?
It depends on what the source of the shock is, right? So, if
Uh-huh.
if the shock is coming from the US because there is an issue of policy credibility or, debates around, the debt ceiling and even technical default, then you may see a kind of a shift away from treasuries as the risk on or risk off trade, right? And I think that is one of the indicators that as a sovereign debt expert that you would look for to get a sign that maybe treasuries aren't performing the historical role that they have. So really, bottom line really depends on the type of shock that you're talking about, and also the regional and the source of the asset shock that you're talking about.
Also, I wanted to ask, fiscal sustainability is this ongoing conversation in the United States, as it should be. And there are sort of two different camps. One is that it unravels slowly, versus another camp, which is it kind of arrives without warning, to use the name of a popular blog, and suddenly people say, "Wow, the U.S. has a real problem here." Someday in the future, right? Declining demographics. It's either going to have to tax people more, cut spending, do something dramatic. So do you think it arrives slowly or suddenly?
I think that what we've seen in many countries across the world, and there really isn't a comparator to the US in this stage of its history, economic history, and just the kind of economic and financial power that the US has. Um, in a way, I think in the US, it's going to be a matter of a slow deterioration. And the reason why I say that is because usually countries where you have a very sharp cliff in terms of debt sustainability are those that have very limited policy flexibility and degrees of freedom, right? So I think that those two factors are in the US's favor, which necessarily may, uh, the knee-jerk reaction is that's a good thing, right? But I think the analogy of the boiling frog, the frog that's in a kind of a pot that's being boiled from cold water, that and essentially it becomes too late for them to do something about it, may be quite apt in the case of the US because it has many degrees of freedom, there is less incentive to really tackle the issue of the fiscal constraints, debt sustainability in a timely manner, and it's easier to kind of let it slip. But we're not seeing it, we're seeing the issue of the fiscal constraint. We've been seeing it for many decades, even when, debt levels weren't as high. And this incremental deterioration in some ways can be more damaging, even though it offers policymakers tools to adjust. And market is adjusting also because it's diversifying its risk from this kind of left tail event that may happen.
I want to ask a question about the Japanese market and the rise in JGB's yields. A lot of countries around the advanced economies have been cutting rates. The Bank of Japan has been in the opposite side of the monetary policy cycle. Maybe the only other country that was tightening that part in the advanced economies, if you want, was Australia, right? But the economy is strong. Inflation is above target in Japan. There's been a lot of corporate governance restrictions. A lot of reason why investors might want to go back to Japan, both at the sovereign investor as well as other assets. Do you see any impact there? First of all, do you see repatriation flows back into Japan from, say, retail Japanese investor out of dollar asset backs into JGBs? And do you see any challenge, and again, in terms of US rates or broader fixed income dollar asset for the US?
Yes, and I think Japan is one of those cases that has confounded economists for many, many decades, right? How does a country with such high debt levels, macro numbers that just don't add up, continue without a sign of an imminent crisis? And to Craig's earlier question, does it happen overnight, or is there a slow deterioration, or how do these debt crises come about? I think Japan is the one that is the mystery and likely to be the mystery for a really long time. But essentially, what we're seeing is a reckoning of very, very high debt ratios and limited policy credibility and constraints coming from all angles. To your question, Fabio, in terms of repatriation risk, there's absolutely a very high risk of repatriation of Japanese offshore investors that are invested in global markets, but in the U.S. markets in particular. It's quite a sizable number that is invested in U.S. assets, both in the Treasury side as well as the equity space. And just looking at the unhedged yields, which is generally how the Japanese have invested in the U.S. markets, you're seeing a narrowing of the gap, right? So that's just price for price comparison. So I think that is kind of like a simplistic first order way of looking at the risk, as in, when it doesn't become beneficial from a price perspective, there is probably a higher risk of coming back on shore or moving to other markets, right? The second factor, though, is what is the direction of travel of the markets and yields within Japan itself, right? And I think that is also an important factor in terms of driving that offshore demand coming back onshore. And I think that the issue of sovereign credit risk actually being priced into the bond market is going to weigh there too. So, I think looking at just what's happening in the US market and saying that, yes, there is going to be repatriation flows is really not the full story, because Japanese investors are also going to be thinking about the risk return profile of onshore investments and perhaps what other alternatives there are, like we discussed before. So I think that, there is certainly a risk, but it's not just a one-way risk. I think it's much more balanced. And, we also have to just think about the driver of what these savings provide, right? On the Japanese market it's not as liquid as the US markets or even the Euro market. There are things that you give up, not just yield.
I think the issue of Japan in that crisis, Japan has a couple of things that are very unique, right? Apart from one, it's an advanced economies, has a very large domestic base of investor. That's different than a lot of countries. And a big chunk of the outstanding JGBs is held by the central bank, by the BOJ. So I think it makes a very unique case where, and I think also help explain why they managed to not face that crisis that other countries have faced, among other reasons.
Lupin, so you put hundreds of millions of dollars of capital at risk in your previous job. We don't give investment advice at the Institute, but I'm curious, let's say someone gave you $100 million today. How would you allocate it across the world in rough numbers?
I do like the emerging market trade still. I think that an emerging market is a big asset class, right? It's a very diversified, fragmented, some may say, asset class. And you can invest in hard currency assets, which are dollar, euro, or yen dominated, but the dollar dominated portion of the asset class dominates the other currencies. And then you can invest in EM local. So probably my allocation would be $2 US dollar assets, a small allocation to provide liquidity, to allow me some diversification to the emerging market asset class. But probably 80% would be invested in EM, with about 60% allocation to emerging market local assets. These are assets that are denominated in local currency, and usually the short side would be the dollar, but you can also diversify your dollar risk, or the risk that the dollar doesn't continue to depreciate, by having a short funding leg that is a mix of euro and dollar. And then essentially the EM local rates story is where you're getting quite a significant amount of your return. And the reason why I like that allocation is because I think emerging market fundamentals have improved. So the fundamental story is quite strong. There are central banks that are on the cutting side of their cycle, and they're cutting with inflation at front and center of their mind. So it's not a profligate rate cutting cycle simply to ease rates because of fiscal concerns, as we have in, say, in other parts of the world. And also that the real yield pickup is quite significant. So that, at least for this year, I think that the EM local and the EM hard currency trade has ways to go. But EM is very, very diversified. You're looking at countries like Chile, Mexico, Brazil, Turkey, South Africa, Nigeria, Kenya, Indonesia, China. So I think you have to really pick where you're going to be invested in. So it's not an EM beta story in terms of what's going to generate returns, but really an EM alpha story.
Wow. I didn't expect the allocation to be so high. That's really interesting.
I should give the disclaimer that this is not investment advice. This is what I would do as an institutional investor investing across fixed income markets.
I got to focus on this a little bit. So it's quite obvious that here in the West, we have very slow population growth, and even slower now with our immigration policies in the U.S. So I'm wondering, as you look across the world for investments, if countries with young growing populations, particularly in Africa, are attractive investments, and if yes, why, and if no, why?
So, one of the things that always used to come out, which struck me, is that you don't invest in GDP and you don't invest in growth, right? That's not what gives you returns. So I think the underlying long-term structural fortunes of a country, while they're important for returns and financial market returns, they're not going to be the single most variable that you're going to look at when you're investing. I think the question of the demographic dividend, which is what you're talking about, and how that can really play into the fortunes of a country is really mixed, right? I think if you're looking at many of the African countries that have young populations, they haven't been able to, unfortunately, harness that demographic dividend to actually generate internal growth, but also perhaps, growth in terms of exporting that labor and that capital, that labor productivity that can be combined with capital to generate returns. Countries that have been able to do it, interestingly, have been kind of countries like Bangladesh. where you have a very large young population, 170 million, population, which is a very large consumer market, and they've been able to move up from very low income status to a higher middle income status, but really through the engine of industries like the garments export industry. And there are issues related to, where that's going to go, but there are very few countries, unfortunately, that haven't been able to harness that demographic dividend. And with the kind of anti-immigration backlash and offshoring factors that are being constrained, it's not clear to me what the path for many of these countries are going to be to harness that going forward.
I think I'd like you to explain a little bit for listeners. This was an interesting comment you made. You're not investing in GDP or even the potential GDP. So can you drill down into that a little bit? Are you investing in good policy or what? What is the benchmark?
I think you answered the question. So really, when you're there are different things, and I meant that um, because when you're looking at a country and selecting whether you're going to be investing in a country, the future growth prospects, of course, are important. Where is this country going in terms of growth? Where is its potential? How is it using its various factors of production? What is the growth engine? Where is it going to have an edge over other similar countries? All of those factors do matter. But essentially, they are the starting condition. They're not going to be the additional factor that drives whether you're going to invest in that country or not. And I think a key element of whether you are going to be moving forward with investments in a specific country is policy credibility and the strength of institutions. The reason why that matters for investors is because we invest with a probabilistic mindset, not a point estimate mindset. So let's take elections, right? So most countries go through elections. Most democratic countries go through elections. As an investor, my job isn't to predict whether candidate A or candidate B is going to win the election. It's really to think about the distribution of probabilities around who will win and what the policies are going to be under those scenarios. If you have a country with very strong institutions, maybe they have a bipartisan fiscal committee, that means that medium-term fiscal outlays can't really expand too much. If they have an independent central bank or a ecosystem where there are checks and balances, the confidence in investing in that country for the long term and the medium term is much higher. And I think that is one of the more critical factors in driving whether an investor sees a country favorably and whether the country's credit ratings, if you will improve over time, and in which direction it will go.
Maybe a big question that you don't have to have an answer, but maybe for the next time you come back. But all of the common thread of all the discussion here is this more fragmented global savings world, and what are the implications where liquidity may be available or where capital can be fragmented in different markets. Do you think this idea of fragmentation of capital markets is here to stay, or this is just a phase that we have seen ebb and flows of some of this over time?
So I think that global capital markets are less fragmented, but more essentially diversifying. And I think that reframing is important. I don't think we're in the world where we have separate ecosystems within which investments are happening, in which investments and savings are generated and kind of coexisting. We have a world where global savings were heavily invested in one part of the asset structure and asset class, and it's now diversifying. I actually am more bullish. I think that makes the world a more, at least the financial markets from that perspective, if you are an asset allocator, central bank or a sovereign wealth fund or a large institutional manager, I think that your risk diversification is a benefit and it's a positive thing, given that financial markets are likely to be much more volatile going forward, or at least even if the actual realized fall is low, you may have much more policy surprises that may move markets. So I think that diversification is a positive. I wouldn't call it a fragmentation. I think it's a positive factor.
Thank you so much for joining us. We look forward to having you back on the podcast.
Thank you, Fabio. Thank you, Craig. Great to chat to you.